talking about?
I wouldn't say necessarily the start of something big. It seemed like kind of this flutter of global financial stress struck a market that really was kind of lost a little bit of energy, right? The S&P was up 6% in 6 weeks, really had slowed down, was making very labored progress, was looking a little defensive, and it was an excuse to have a little bit of a pullback. Nothing too serious, doesn't change the trend. If you look at, the chart, it just looks like a little bit of a wiggle for now.
Mike, US banks down because they've got fundamentally worrying exposure to Turkey, or because it's a risk-off sentiment, yields are moving, etc.?
I think it's mostly risk-off. We were talking earlier about this sort of spectrum of reaction to what might be the worst case scenario. And so you have European banks down 3%, US banks, as you mentioned, the yield curve gets a little bit compressed, the yields come down, and it just doesn't seem like it's anything that appears to be the start of a chain reaction of, leverage trades, hedge funds blowing up. I mean, that's the kind of thing you would expect to see kind of really interrupt the positive story for banks.
But Evan, there's lots of idiosyncratic things with Turkey, Russia too, which has had a massive sell-off in the ruble because of sanctions, et cetera. However, when interest rates, especially in the short term here in the United States, when you can suddenly start getting much higher interest rates in the U.S., EM starts to sell off because they're riskier. I just worry, is this a little whisper of what could happen if really we start to see a sharp rise in U.S. interest rates?
I think it is more than a whisper. I'm not saying that it will be Turkey that brings on the correction. It's very hard for you to draw a direct line from Turkey. Turkey's a bit of an economic sideshow, certainly for the United States. But if you look at what else is going on, U.S.-China, Russian sanctions, North Korean negotiations, NAFTA negotiations, Iran sanctions. How is the Trump White House juggling what is at least 6 or 7 bilateral negotiations ongoing right now? I mean, Turkey's a sideshow, and you could see even a little blow up in Turkey has created this kind of turbulence in the market. I think over the next few weeks, you're going to see the Trump White House have a very hard time juggling a series of bilateral negotiations. So I think the headline risk is very great. Even though the U.S. economy is doing well, there's nothing that's going to blow up the U.S. economy.
It will hurt the U.S. market eventually, is what you're saying.
Eventually. I can't draw the direct line, but the reality is that when you get into risk-off mode, it's just not good for U.S. equities. U.S. equities right now are a little bit vulnerable, just as equities across the world are, frankly.
Now, tell me what the dollar is going to do in response to all this. Yep. That would be the instrument that kind of hurts us.
Yeah.
So we have to see. I mean, right now you're at a 13-month high in the U.S. dollar index, but really still within a 2-year range.
I think the one thing that might happen, which is the second part of today's story, is the CPI, which is, the
Hold on, we're getting to that. We want to tell people what it is before we talk about it.
Okay. Sorry for getting ahead of myself.
Yes.
No, you're not. You're spot on timing. But as Evan mentioned, we got CPI this morning. Prices continue to rise. According to the Labour Department, core consumer prices are up 2.4% since this time last year. That's the largest increase since September 2008. Evan.
Well, I was going there.
We should have just continued.
Yeah.
No, we want people to know what the data was before you talk about it.
The data came in as expected, maybe a little on the hotter side. But where this is going is basically the bond market right now thinks there will never be inflation ever again. Today was the risk-off trade, so you saw the yields come in, and even on the 10-year. The CPI data would suggest, although it's not guaranteed, that somewhere along the line, the U.S. economy is normalizing, inflation is normalizing, and wages may someday go up, and you may get a spike, probably hard to use the word spike, but you may get an uptick in inflation. You combine that with the $1 trillion deficits that the Trump administration is running, and you run the risk of the bond market falling out of bed. I don't think it's about to happen. I'm just saying that is the risk.